Welcome back. Today we're doing a deep dive, a really data-driven look at one of the absolute most dynamic corners of the equity market. I'm talking about Flexicap funds. Specifically, we're going to put the Invesco India Flexicap fund under the microscope. We'll look under the hood at its mechanics, chart its historical performance, and yeah, we're going to demystify some pretty technical risk metrics to see exactly how it achieves its returns. If you're looking for a clear, no-nonsense breakdown of how this wealth-building tool actually operates, well, you're in the perfect place. Let's get right to it.
So here's our roadmap for this explainer. We're going to start by understanding Flexicap funds, then track this fund's historical performance. After that, we'll look inside Invesco's unique advantage, figure out how to navigate its volatility and market risk, decode some key risk metrics, and finally wrap up with a quick guide for beginner investors.
Okay, let's dive right into this first part, understanding Flexicap funds.
So what exactly is a Flexicap mutual fund anyway? Well, honestly, the magic word here is freedom. It's basically an equity scheme where the fund manager has absolute liberty to invest dynamically across large, mid, and small cap stocks. As market opportunities shift around, the manager can just shift the money right along with them. Instead of being completely boxed in, forced to buy only mega corporations or only tiny startups, the managers can literally just go wherever the growth is. That inherent flexibility, that is absolutely the category's main selling point.
To really wrap our heads around this, we've got to look at the rules of the game set by SEBI. The baseline requirement here is that a minimum of 65% of the fund's assets absolutely must be invested in equity and equity-related instruments. But here's the real kicker. Beyond that 65% minimum, there are zero, and I mean zero, cap-wise restrictions. Contrast that with multi-cap funds, right? Those are legally forced to hold a minimum of 25% in large, mid, and small caps respectively, regardless of what the market's doing. In a Flexicap, if small caps suddenly look super dangerous, the manager can just abandon them entirely. This complete lack of restriction is exactly why you see performance vary so wildly from one fund house to another.
Moving right along, let's get into tracking historical fund performance.
All right, let's look at the hard numbers. We need to objectively compare the fund's historical performance straight up against its benchmark, which is the BSE 500 Total Return Index, and of course, its peer category average. Check out that since inception row right at the bottom. Since this fund launched back in February 2022, it has actually delivered a 16.29% return. That significantly outpaces both the benchmark's 12.17% and the category average's 12.39%. Actually, if you look across all three distinct timeframes, the 1 year, the 3 years, and since inception, the fund has pretty consistently stayed ahead of the pack. Now, looking specifically at the 3-year compounded annualized growth rate, and this is based on Invesco's reported regular plan data, we're tracking an 18.19% return for the fund compared to just 12.52% for the benchmark. I mean, wow, that is a stark difference. Over 3 years, that extra roughly 5.5% compounding year after year, that creates a massive divergence in the total wealth you're actually generating. And look, this outperformance isn't some happy accident. It's a direct result of the highly active strategies being deployed by the fund managers, Taher Badshah and Amit Ganatra.
Let's turn the page to Section 3, Inside Invesco's Unique Advantage. Let's actually break down where the fund is putting its investors' money right now. First off, you'll notice a really heavy 98.75% of the total assets are exposed directly to equities. Now look closely at this split. We've got 50% in large cap, 30% in mid cap, and 19% in small cap. This tells a very deliberate story. They're essentially anchoring half the portfolio in the relative stability of those big, established companies, while dedicating nearly the other half, 49% combined, right, to the higher growth, way more aggressive mid and small cap sectors.
And this brilliantly illustrates their strategy. The fund boasts an active share of 73.52%. Now, what does that actually mean for you? Well, it means the managers aren't just lazily mimicking the index. Nearly 3/4 of their portfolio deviates significantly from a standard passive index approach. They're using a really highly active bottom-up stock selection process. So rather than just buying a whole sector blindly, they are rigorously evaluating individual companies. They're hunting for those high-growth, high-quality businesses that show really strong returns on equity and capital employed.
All right, up next, navigating volatility and market risk. Because transparency is absolutely key, we have to talk about this. The SEBI standardized riskometer classifies this exact scheme as very high risk. So if you're a conservative investor, this is a pretty crucial warning sign to pay attention to. Remember that meaningful 49% allocation to mid and small cap stocks we just talked about? Well, that naturally brings much higher pricing volatility.
especially when you look at some of the recent market fluctuations in those specific sectors. Smaller companies simply carry less liquidity than the large-cap giants. That means when the broader market gets turbulent, the swings here can be sharp, really sharp. Honestly, it's just the required price of admission if you want that potential high growth.
But how well does the manager actually handle that risk? Let's look at the capture ratios. The upside capture ratio is 123, and the downside capture ratio is 98. Let me break down what this means in plain English, because it's super important. It means that when the broader market rallies and goes up, this fund has historically captured 123% of those gains. It actually outperformed the positive momentum. But, and here's the best part, when the market crashes, the fund only experienced 98% of the fall. So you're getting more of the upside, but slightly less of the downside. That is highly effective downside protection, combined right alongside aggressive growth.
Now we're getting into the really fun, nerdy stuff. Decoding key risk metrics. First up on our metrics list is alpha. I like to think of alpha using a maritime metaphor. Imagine it's the ship captain's unique skill in navigating the ocean to arrive at the destination way faster than the currents alone would ever allow. Mathematically, it measures the excess return generated completely independently of the market's movements. This fund has an alpha of 6.37. Now put that into perspective. The category average is sitting at just 0.95. That is a massive risk-adjusted outperformance. It literally proves the fund managers are adding significant, measurable value simply through their stock-picking abilities.
Okay, next is beta. So, if alpha is the captain's skill, beta is the ship's sensitivity to the ocean's actual waves. A beta of exactly 1 means the fund moves perfectly, 100% in sync with the market. Here, we're looking at a beta of 1.05. So what does that tell us? It means the fund is about 5% more volatile or sensitive than the broader market. It's going to rock just a little bit more in the waves. But again, this makes total sense and aligns perfectly with their heavier allocation toward those mid and small cap growth stocks we've been tracking.
Finally, we have standard deviation, which is currently sitting at 17.36%. Standard deviation is basically a statistical measure showing the wide dispersion of returns around their mean. Essentially, it mathematically proves exactly what we've been discussing all along. A higher standard deviation means the range of performance is wider. So when you compare it to the category average of 15.61%, this 17.36% metric confirms you are absolutely signing up for a bumpier ride. The highs will likely be higher, for sure, but the lows could be lower, all driven by that specific growth-oriented style of the fund.
Wrapping things up, let's look at a guide for beginner investors.
If you're sitting there trying to evaluate if this fund actually aligns with your own wealth-building goals, here is a really clear 4-step assessment process based on everything we've unpacked today. Step 1, you absolutely must be comfortable with that very high-risk profile and the general unpredictability of equities. Step 2, review that 50-30-19 market cap split we talked about and make sure you really want nearly half your money in mid and small caps. Step 3, weigh that impressive alpha, the reward, against the higher beta and standard deviation, which is your risk. And step 4, assess your personal timeline. Flexicap funds, especially the more volatile ones like this, really require long-term ownership so the managers can comfortably ride out market cycles without being forced to sell at a loss.
And that brings us to the end of our analysis. The data clearly shows us a fund that has brilliantly leveraged its structural freedom to deliver significant risk-adjusted returns. But it undeniably demands an investor who can stomach the volatility of active, growth-focused management. So I want to leave you with this final thought to ponder today. How will you balance your own portfolio's need for flexibility against the harsh realities of market unpredictability? Really think about it. Apply these insights to your own financial journey, and whatever you do, keep learning. Thank you so much for joining me for this explainer, and I will catch you in the next one.